without further ado, again, welcome everybody this evening. How to sell credit spreads for income. I am Don Kaufman. I'm going to be your host this evening. A few disclosures as we get through here. We are not financial advisors or a broker-dealer. Again, the reason I always throw that up there initially is, well, the previous 15 years of my career I did spend in the brokerage side of this business. That's over and done with. I got out of the brokerage business because of the regulatory environment. This is a copyright disclaimer. This is ours. This is not yours. If you want the recording, just ask us. That's all we're saying over here. We also like to throw our contact information right up front. Support at TheoTrade.com. If you ever need to get a hold of us for anything in any way, shape, or form, we do respond to emails. We also answer the phone. I know that's something novel. I respond to a few hundred emails a week, so we encourage you do email us from time to time. It's a little bit about my background. So I'm the co-founder here of TheoTrade. I've been trading for, since the late 90s, now a 20-year trading career. I do have about 17 years of thinkorswim platform experience, a little bit of my background. So I started trading, as I said, in the late 90s in Chicago. A few years into my trading career in Chicago, which is predominantly the Chicago Board Options Exchange. A few years into my trading career, I was invited into, at the time, was a startup firm. There was a handful of people working there. That firm was called thinkorswim. I actually built the education division of thinkorswim. I went on to run the education division until an acquisition, of course, by TD Ameritrade in 2009, where ultimately I ended up taking over education at the time for 7 million clientele of TD Ameritrade. I resided at TD Ameritrade until 2015, where ultimately we turned around and we launched TheoTrade. So it's a little bit about some of my background. I've done a number of different CNBC tours over the years, pretty much every major network out there. This is the one, though, that, if there's going to be a memorable moment of CNBC, this is the guy you want to be pitted against, Mr. Wonderful himself. And at the time, he was the long and I was the short. And Apple proceeded for the next 6 months to do nothing but sell off. So felt fairly good. A little bit about TheoTrade. So we specialize in education for stocks, options, futures. We're founded by professional traders, of course, including myself, and trading educators. Everybody on staff here at TheoTrade that is involved in the trading side of the business has a minimum of 15 years of experience. A couple of us have many decades. We're here to help you guys mitigate the risks in the market while learning a skill set that can last a lifetime. Now, who is TheoTrade and who really are the instructors at TheoTrade? So one of the things that I try to make very, very apparent, like TheoTrade, it's not just Don Kaufman. We have, again, 6 full-time instructors here. Doc Severson, Stocks, Options, and Technical Analysis. Jeff Bierman. Jeff Bierman's actually an analyst, trader, and he's actually the former chief market technician of TD Ameritrade. Jeff Bierman actually worked side by side with me at thinkorswim and TD Ameritrade for 7 years. We were actually pretty much side by side. We have Corey Rosenblum. Corey, senior strategist and swing trader. He's our resident swing trader expert. Steve Slim Miller, 43-year veteran stocks, options, and futures traders. Slim, he actually started in the early 1970s, right after the Chicago Board Options Exchange was founded. Last but definitely not least, we come in with Tony Rago. He is a NASDAQ and intraday strategist. That's it. That's what he does. So again, this is 5 full-time instructors. In addition, of course, to myself, that would be our team here at TheoTrade. What you're going to learn in this presentation this evening. So let's start with the idea. We're going to learn why. We're going to see this monumental shift to more volatile markets, okay, and why 2018 is going to be optimal for selling options premium. I'm going to discuss that right up front here. We're going to talk about central bankers, rising interest rates, learn why higher rates will translate into opportunities. All right, I want you guys to think about that because I'm going to talk about it here momentarily. Yeah, higher interest rates translates into opportunity. Discover how probabilities are really law in the markets and how you can create high probability trade setups in any market condition. Well, ideally, though, in a rising rate environment, options are really going to kick in. Powerful strategies on how to use credit spreads so you can create consistent returns. And then really, what's some of the major benefits of trading credit spreads, okay? And why do so many professional traders, utilize the credit spread or, collecting income kind of a trade out there? So let's jump right into it. I just wanted to go over, on the peripheral, just a little bit of what we're going to be covering tonight. As I said, we'll be answering some questions right along the way. So at any time, I don't ask rhetorical questions. You guys will be able to jump in. Let's start with this. Have no fear. The Fed is here. By the way, I love the little play in words in here. It's fear the Fed. Anyway, have no fear. The Fed is here. Markets have seen, and this is where I want to start this evening. Just markets have seen unrelenting complacency, right? Lack of volatility in recent years. Although in the last month, has seen a degree of fear return, we're still flying under the radar for volatility. Think about that. I mean, what have we seen so far? Oh, February 5th, it moved. I think the market moved on February 5th, and here we are now on March, early March. And all right, we're still flying under the radar, though, for volatility. Furthermore, considering, look at the future right now. The myriad of risks on the horizon, complacency is just, it's remarkable. That's all you can say is how complacent we still are with the myriad of risks. It's absolutely remarkable. Multiple rounds of quantitative easing and the influence of the Federal Reserve is decisively behind both the rally, and that's the rally, of course, starting in 2009, and the degree of complacency in capital markets. Now, with that in mind, here happens to just be a quick 5-year chart of the volatility index. If you're not familiar with the volatility index, that's all right. But it's the VIX over the last 5 years. And I just wanted to show you, when I say years of complacency, for the most part, the vast amount of trade in terms of volatility, and again, many are familiar with the VIX, but the vast amount has actually been between, the 10 and 15 level in terms of the VIX. So if you look at a much longer duration of the VIX, you'll actually see that the VIX average now is closer to 18. So right now, we haven't really even caught our stride. We're back to what has been a little bit of a volatility average going back obviously more than 5 years. When you start to look at the VIX in like a 15-year term, you're looking more like an 18 average in the VIX. And, today, where's the VIX today? For those of you interested, we're at 19. So when I talk about volatility, I may reference the VIX, and I think it's fair to say that most people do have some understanding of the VIX at this point. Now, this is not going to be, critical moving forward for today's presentation and understanding of the VIX. This next part is, monkeys throwing darts. The last 9 years, monkeys throwing darts made money. And if you're not familiar with this, they literally had monkeys throwing darts to make money. But moving forward, you're going to need a definitive skill set. By the way, the monkeys throwing darts, I wasn't trying to be condescending in any way, shape, or form. But quite literally, they had, a chimp. And by the way, the real study wasn't done with darts. They had a chimpanzee that took finger paint and touched, giant symbols that were in his cage. And those stocks they actually picked, and those stocks outperformed many of the fund managers out there. But if you look back over the last 9 years, really since the 2009 timeframe, the monkeys throwing darts made money. But moving forward, you're going to have a skill set. What we intend to do tonight is introduce you to the skills and, more importantly, the criteria needed to thrive in markets. Again, I want you to remember this slide. The reason I want you to remember it is, what you hear tonight, I want this to change the way that you view markets. And the reason I want you to remember the slide is because I'm telling you right here and right now, and there's no if, and, or but about this. You want to survive in markets, and you want to thrive in markets, you are going to have to learn something other than, I think this stock is going up. Because, well, let's get right to it. All good Fed things must come to an end. Starting in 2018, the Federal Reserve is effectively departing the marketplace and will commence contracting the $4.5 trillion balance sheet. Okay, let's be clear about something. There's no if, in, or but about it. They're doing it already. In 2018, they kicked off, the departure of the balance sheet. As Fed capital declines, interest rates will increase. They've exploded recently. Investors and traders will be forced to unwind positions in countless marketplaces. In effect, as the Fed pulls away the punch bowl, capital markets will become increasingly volatile. And this is one of the concepts that I really want to hammer home, of like, why do you need a skill set of being able to go out there and sell credit spreads? I don't know, because it's going to be next to impossible to figure out, what's going to go up? What's going to go down? We're going to be in a seriously volatile situation, moving forward. There's a $4.5 trillion balance sheet. You want to see what it looks like? Looks like this. Now, this is a complicated slide deck, and I want to show you exactly what it is. By the way, I give credit where credit's due. This is actually from JP Morgan Asset Management. Okay, what you're looking at right now happens to be degrees of quantitative easing. Quantitative QE1 begins in 2008, obviously when the market crashes. This is the end of QE1. QE2 kicks in 2010. All right, QE3, by the way, QE3 has gone to eternity, and they pretty much are cutting it off. The end of QE3 was in 2014, but they hadn't contracted the balance sheet. The forecast reduction just began. And we're actually right now, we're somewhere right in this neighborhood on the downslope. If you look at MBS, that's mortgage-backed securities, this is treasuries. And this is what the Fed has purchased. They've purchased treasuries, and MBS is mortgage-backed securities. So you want it, there it is. And this is a $4.46 trillion balance sheet that they're now contracting. And people are sitting here going, oh, well, what's going to happen? I'll tell you exactly what's going to happen. The shift to volatile markets. This is return of being a trader. This is going to be what? The Fed balance sheet decline has already begun. Moving forward, you need to be fully aware that the Fed no longer has your back. Now, that right there, there's two things I wanted to remind you of this evening. Number one, over the last 9 years, the monkey throwing darts could have made money in this business because you could throw money pretty much at anything other than maybe GE, and you're going to make money. Right now, Fed, this is wind into your face. They ain't got your back anymore, and they have already made that clear. If you didn't hear some of the testimony last week, Jerome Powell, nobody knew what to expect of him. Now we know what to expect. We ain't got your back anymore. It's time to get back to selling options premium. As increases in volatility are underway and there are more forthcoming. And that's, again, the starting place. Now, learning to sell options. Many of you have heard through the grapevine, selling options is the way to make money. Well, if you've experimented, though, with selling options, you know full well there is definitively risk involved. Today's session, we're going to separate the myths from the real risks and the fact from the fiction in selling options premium, right? And yes, I said the O word. I said options. Now, don't panic. You could do this. If you don't know anything about options in today's session, that's fine. Deadly serious. If you don't know anything about options, you're going to learn something. I want you to be able to grasp big concepts. Again, learn to grasp big concepts regarding probability and risk. So we're going to dive in from there. But again, if you know nothing about options, we're going to move at a pretty good clip again tonight. So we're going to dive in. First, we're going to talk about probability and profitability. Your trading is based on probability. You and I can both go out. We can create trades all day long with a 90% probability of success and still lose money. That's the one thing, listen, when it comes to, education in this business, when I say education in this business, you could hop on, Google search and you're going to find probably a few thousand different sites with different types of education. Okay. And a lot of them tout check me out. I got a good track record. Check this out. I've been right 90% of the time. When are people going to wake up and realize it doesn't matter if you're right 90% of the time? Because the other 10% of the time, you could get absolutely hammered. Probability alone does not make you profitable. You better remember that, because that's the fact from the fiction. Just because you're like, oh, I was right 90% of the time. Yeah, right up until the point the freight train hit you in the head. I mean, that's the reality. And if you've ever gone out and you've traded, you know that to be reality. Markets, they're always going to be a trade-off. Now, again, markets are a series of trade-offs. Higher probability equals higher risk. So you could be right 90% of the time and still lose money. So where can I find an edge? That's what everybody's here for, right? I mean, that's literally what, where can I find the edge? Great. Get ready, because I'm about to show you something that is very, very important. Now, we're going to go through and we're going to talk a little bit about probability here. And if you're brand new to trading, okay, this is going to come as a little bit of a shock to you. So we're going to go out and we're going to have this. This is a stock. By the way, this looks like every stock to me. What, you don't see it? Here, I like to draw on the screen, so I'm going to bring my little writing board over here. So this is a stock, and the stock is trading at 100. Now, just tell me what you think the stock can do. Well, the stock can go up, and the stock can go down. Let's ask, what can the stock do, for instance, in the next 30 days? All right, what can the stock do in the next 30 days? It can go up or down. How far? Let's say it can get to 110, or conversely, the stock can go to 90. Now, people, listen, I don't care what stock this is. Call it anything you want. If you've ever been to a presentation that I've done before, I call every fictitious stock, I actually call it stock. I don't care if it's stock. I don't care if it's Microsoft. I don't care what you trade, because in the end, it's probability and price. So let's say that in the next 30 days, where can it go? Well, it could go to 110. It can go down to 90. What's the probability of that occurring? Now, I really want to know, what's the probability of getting to 110 versus the probability of getting to 90? Anybody? All right, these are not rhetorical questions. You can jump in here at any time. All right, and it's, by the way, it's not necessarily a 50-50 shot. And that's usually what people come up with. And I'm not trying to pick on you, but it's usually people are like, well, it's about a 50-50 shot. Yeah, but there's not necessarily a 50% chance that we get all the way to 110 or a 50% chance we get all the way to 90. The odds of moving, okay, plus 10 or minus 10, that starts to get a little bit diminished. Let's throw a probability on here, okay? Let's throw a probability. Let's say, for example, there's a 30% chance of going up here to 110 and an equal 30% chance of getting down here to 90 in the next 30 days. Now, obviously, it depends on the stock. This is stock, but there's a 30% chance of getting to 110 or a 30% chance of getting down to 90. Okay? And when you trade, now, a lot of you guys, listen, you're not necessarily into options positions, but, I've been doing this for so long now. It was about, 2000, 2001. I went out and actually spoke to a group of traders for the first time ever. I started again in the late 90s. And in all fairness, I came from a family of traders. So my family started trading in Chicago in the early 70s. I grew up a little bit around the business. So, people always ask me, how long did it take you to learn this stuff? I don't know. That's kind of like asking me, how long did it take you to learn the alphabet? I don't know. I literally grew up around it. And one of the things that most people don't realize about the business is this, so many years doing this, I trade a little bit of everything. So I just want you to know, I trade stock, okay? I trade options, and I trade futures as well. There's no one-trick pony out there. You trade stocks, options, futures. You could buy it, you could sell it, you could sell it, you could buy it. Who cares whether you trade stocks, options, and futures? But one thing I will tell you, without unequivocation, options are often going to tell you what the stock is capable of doing. And without the options, you're blind on the stock. See, the weird thing is, I'd go to some trade shows and people come up to me and they're like, oh, yeah, man, you're that options guy. And I'm like, oh, no. I've traded, a couple of million shares of stock every year. So I guess I'm a stock guy. And I've also traded a few million contracts of futures. I guess I'm a futures guy, but I've also traded every year, a lot of options contracts. But the point I'm making with this is that trading is based on probability, and the options themselves, okay, are probabilities. Tonight, I know this sounds crazy, but tonight I'm going to show you how to calculate that 30% probability. Like, did I just pull that out of thin air? How did he know that there's a 30% probability of getting up, for instance, to 110? I'm going to actually show you how to do that. See, people look at stock and they go, oh, I don't know. What's the chance of getting up there? Okay, well, let me blank the screen for a second and talk a little bit more about that. So here's the stock at 100. And as I said, what's the probability of getting to 110? Let's put it at 30%. Now, this 110, okay, how did we know 30%? Well, it was based on the price of the option. Now, this 110, all right, let's go back into it now and let's look at it from an options standpoint, because this is where I'm going to tell you, even if you trade stock and you have never an intention of trading options, you got to learn this stuff. Okay, you have got to learn this stuff. And I'm not talking about one standard deviation, nothing like that. But I want you to look at an option chain. And in this case, we're going to look at what's called a 110 call. This is a 110 call. What's a 110 call give us the right to do? Now, for those of you that have never traded options, a 110 call gives you the right to buy the stock at 110. Do you have to buy the stock at 110? No. But the 110 call gives you the right to buy the stock at 110. And for that 110 call, you are going to pay what's called a premium. The premium in this case, let's put it at $1.50. So you're going to have to pay $1.50. What's the most you can possibly lose? Now, if we went out and we were to buy this 110 call, the most we could possibly lose is $1.50, right? But then where do you need the stock? You don't need it at 100. You don't even need it at 110 because you have the right to buy the stock at 110, but you're not going to need the stock at 110. You're going to need the stock at 110 plus the $1.50. But I want you to remind you of something. This trade has about a 30% probability, 30% chance of doing what? Not of making money. There's only a 30% chance of even getting above 110. And I'm going to show you tonight how to calculate that 30%. Without having to use any like crazy models or nothing like that. Forget all that garbage. There's going to be a 30% chance. Okay. Now, if somebody approached you and they said, I want you to buy this option. You go, okay, I can go out, I can buy the option. They go, you're only going to have a 30% chance of even getting to 110, which actually gives you closer to like a 25% chance of getting your money back. Now think about that. There's a 30% chance that we're going to be above 110. That means at like 110.01. That's what that means. 30% chance of going to 110.01. And that is crazy, right? Because you're like, oh, sign me up for that one. Now, granted, could the stock go above 110? Of course it could. Okay? The stock could even get to, for instance, 130. And if the stock goes to 130, you're golden. Okay? Gold, Jerry, gold. But it's a very unlikely scenario. And when you start looking at probabilities, right, this is what they're about. So again, a few things to kind of recap before we really dig into this is you have to understand that the options market is dictating to you how far the stock can move within a given period of time. Options are listed for days. Like there's options out there now for 7 days. There's options out there for 14 days. There's option for 21 days. There's options, for instance, for 30 days. There's all these different options now. You know what those options are doing? It's giving you, okay, a feel for how far the stock can move within a given period of time. And if you're not using that today, you are at a severe disadvantage. That's where I wanted to kick off tonight. Because again, anytime that somebody comes and they spend an hour with us, I want you to be able to take something away and think like, hey, that hour was worthwhile, and be able to take something away and say, hey, I'm actually learning something over here. Some people are aware of this, some people aren't. Okay? And when you look at a trade, okay, and you say to yourself like, hey, what? That thing has a 30% chance of getting above 110. What's the opposing is also going to be true. And the opposing is this. That means there's a 70% chance that we're never going to get to 110. That's a good starting place. Now, let's start getting in a little bit deeper over here, okay? Now we're going to talk about selling out of the money options. So, this is the first introduction to really going out and learning to use this in context, okay? Because we are talking tonight about trying to create some income, trying to use some degree of consistency in essence to do that, and to gain consistency in trying to generate income. You better know, okay, what options to sell, what options to buy, and specifically the probability behind it. So now to further this example, all right? To further this example, now the stock is trading right at $100, okay? And we're going to sell a 110 call for $1.50 credit. And we're not buying the call, we're selling it. Now this is the first time if somebody's talking about a call for the first time, you have to realize you could buy a 110 call, okay? Or you could sell a 110 call. Now, okay, you got to decide which one you want to be on this. If you buy it, you're going to pay the $1.10. If you sell it, okay, or apologize, $1.50. If you sell it, you're going to collect the $1.50. What side of the fence do you want to be on? Now, buyers over here have rights. They have the right to buy the stock at 110. Sellers, what? Obligations. They're obligated. I'm cut off on the edge of the screen. So they're obligated. Obligated to do what? Give somebody stock at 110. You go, whoa. Wait. Back up a second. How can you sell something that you never even owned? I'm not selling something I never even owned. I don't have to own the stock. I don't want to own the stock. I never even had to want to own the stock. I just go out and sell a 110 call. What I'm doing is actually selling myself into an obligation. I'm obligated to give somebody stock at 110. Now think about this. If the stock stays flat, okay, and this option expires, right? When could it expire? I don't know, maybe in the next 30 days. In the next 30 days, this option expires. Who gets to keep the $1.50? I do. I get to keep the $1.50 if the stock is at 100. Why? Because nobody wants the right to buy the stock at 110 when the stock is at 100. What happens if the stock goes down to 90? Nobody wants the right to buy the stock at what? Nobody wants the right to buy the stock at 110 when the stock's trading at 90. So what happens? You get to keep the $1.50 credit. What happens if the stock goes to 105? You're probably going to wet yourself because it's getting close. But you know what? You still get to keep the $1.50 credit. What happens if the stock goes right here to 110? Well, still, the option to expire worthless. Now, where do you get in trouble? I'll tell you where you get in trouble. What happens if the stock goes to 130? If the stock goes to 130, somebody has the right to take stock from you at 110. But, madame, you do not own the stock. So what do you have to do to get the stock? You got to buy it at 130 to give it to them at 110. And what are you getting? You're getting killed for about $20. Ruh-roh, Radley. You're going to lose about $20, but you collected a $1.50 up front. And think about that. It's big league risk. Big league risk. So I just went through all this example here like, this is too much. But I want you to realize something. Let's blank the screen for a second. I want you to realize something about this example. By selling that 110 call, you have effectively about a 70% chance, okay, of keeping the $1.50, 30% chance of losing it. But this isn't enough. You can't just bet, the life savings, because what happens if the stock pulls an Amazon and it goes from 100, where's Amazon right now? 1,500 and climbing in the after hours. I mean, you just don't know where the stocks can go. Things can get crazy. So it's important to learn how to mitigate this risk. And it's really important to know exactly what options to sell and which ones to buy. Are we okay at this point? Because again, I want to make sure that even if you're brand new, you're like, I don't even know what an option is, but that kind of makes sense. That's where we want to get you to, at least at this point, right? So, at some point tonight, even if you're watching this recorded, just give me an amen, something to let me know that, you're alive, you're well, you kind of get it. And if you don't, that's okay. Like, I can go through it. We'll go through this, as many times as we have to. It's okay. I got nowhere else to be tonight. Let's continue. Okay. High probability credit spreads. All right. Having walked through a few just to the basics, we're now going to discuss the credit spread. Okay. We're going to get into spreads. Credit spreads are, by definition, option spreads, where we're going to receive a credit balance in the initial transaction, meaning we're actually going to take in a credit. For instance, I'm going to go out there and sell myself into an obligation like I showed you a moment ago. I'm going to collect $1 for the obligation, right? Credit spreads are also defined risk trades. Now, that's the first time I mentioned it tonight, defined risk. All right, what does that mean? Well, it means you know precisely the risk and reward prior to ever placing any trade. To me, that's important. Let me tell you guys something on the side here, okay? So for 15 years, I ran the education division of what became, number one, thinkorswim. We had the largest options order flow in the entire, okay, retail industry, bar none. After we were acquired by TD Ameritrade, okay, we were by far and away the largest options order flow, okay, by a multitude of triple of any competitor firm. And the coolest thing was, being the lead in education, I got to look at everybody's account, got to know what works, what doesn't. And I tell people that we used to study what clients did. And the one thing I learned over years, those, when they got into this business, if they didn't define the risk, they just panic, they lose control. They're like, I can't take it. You have to know that this is defined risk. You're going to know exactly what the risk and the reward is prior to ever placing a trade. Credit spreads allow traders to dial in probabilities. So there's two things that you can learn to dial in immediately. You can dial in your risk, you can dial in the reward, and you can dial in the probability. That means if you want an 80% probability of success, you're going to know exactly what options to use. And I'm going to show you precisely how to do that, okay, in just a moment. Now, one thing, there's what I call the many facets of credit spreads. So credit spreads are referred to as a lot of different stuff in this industry. And listen, I want everybody to know. The Chicago Board Options Exchange started in 1973. In 1976, 77, they had calls initially and then they listed puts. Seriously, they listed calls and listed puts. You've been able to do spreads since the late 1970s. And it's funny because everybody's like, well, it's called selling premium. Well, it's called credit spreads. Well, it's called short spreads. Well, they're bear call spreads. Well, they're bull put spreads. You know, all this crap is the same stuff. In the end, you got calls, you got puts. You could buy it or sell it. All of these are the exact same idea. There are bullish spreads. There are bearish spreads. Some people use the terms bull call spreads, bear put spreads. Okay, bull put spreads, bear call spreads, short spreads, credit spreads, premium credit spreads. They can be used to create both bullish and bearish. But I just wanted you to know that these things are going to be referred to in a number of different ways. And the reason I mentioned all the way back to the 70s is because, you see the same stuff come up. Somebody's like, oh, you got to learn how to do some short spreads. You got to learn how to do some premium selling. All they're talking about is selling spreads. That's it. I just want you to know that. So that's the many facets of credit spreads. It's very important. Now, tonight, right here, right now, I'm going to take you through, okay, a high probability credit spread. This is a credit spread right now, right here. And this one is done with calls. Before I go any further, okay, this one's going to be done with calls. This, okay, happens to be a bearish trade. Why? The stock is at 100. I'm going to sell a 110, 115 call spread. Now, I'll explain the call spread here momentarily. But when I sell this spread, the way you think of it, when you sell a 110 call, what are you thinking? If the stock starts to go up, anyway, when the stock starts to go up, you're like, oh no, go down. Oh, please go down. Don't come close. Which actually, okay, implies that it's a bearish trade. By the way, this is the bearish side. This is down to 90. This is the bullish side. This is up to 110. So when you start doing these trades, if you're selling a call spread, it is a bearish trade. If I were to sell a put spread, it would be a bullish trade. For tonight, to keep it easy tonight, I'm just going to use some calls. I'm just going to use a couple of bearish trades, which right now I am into because we have had some bearish moves lately, and I like it. By the way, you trade long enough, you become a bear. It's okay. You trade long enough, you become a bear. Not because you're always praying that the market tanks every single day, although that is fun. You're always a bear because it produces, okay, better probability credit spreads. it produces higher probability credit spreads. I can't stress that enough. Let's take you through this example. Now, get down to it. So in this example, we're going to go out and we're going to sell a 110 call. Now, just like we did a minute ago, we're going to sell the 110 call and we're going to sell it for $1.50 credit, right? Selling the 110 call, again, let's bring it over here. We're going to sell the call and we're going to collect $1.50 credit. Simultaneously, we're actually going to buy the 115s. We're going to buy the 115s. We're actually going to pay for them 50 cents, and that's a debit. This nets out to what? It's a net credit of $1. So what's the risk? Well, here's the crazy part. Here's the crazy part about the spread. Now, this is a defined risk spread. Why is it defined risk? Because you're selling the 110 call. Now, if you sell the 110 call, you are obligated. Remember, sellers are obligated, right? You are obligated to give somebody stock at 110. But what happens if the stock goes to 120? If the stock goes to 120, well, you're obligated to give it to somebody at 110, but you also own the 115. So what? You could take the stock from somebody else at 115. So what happens? You'd have to give somebody stock at 110, but you're capable of buying it at 115. What's the most you can lose in a $5 wide spread? What's the most you can lose in this $5 wide spread? Well, legitimately, you can lose $5, but you collected $1 up front. So the definitive out-of-pocket risk is $4. $4. Now that, okay, that is where we want to stop for just a second. Make sure everybody's tuned in and turned on and kind of gets this, right? So I want you to, again, go through the little scenario over here so that you understand the concept. First of all, I am selling the 110s and buying the 115s. Now, this is actually done as one transaction. This is done as what we call, okay, a spread. It's actually done as one transaction. You sell one and buy another. Now, I know inevitably, somebody comes, what about commissions? I have to pay commissions. Don't you worry about a thing. We're going to talk about that later. Come on, write a note to yourself over there, and you're going to say, what about commissions? Oh, nice. 2 people just came in and said, what about commissions? Okay. And I will tell you everything there is to know about commissions because I was in that business for a very long time. So this trade is done for a $1 credit, but you can lose $4. Now, time out. You say to yourself, why would I ever want to do a trade where I can collect $1 and yet my risk is 4? Why would I want to collect $1 and risk 4? Because the probability of making this dollar is extraordinarily high. And you know, a lot of people, they don't really get where some of the edges. Now, this is stuff that we teach here at TheoTrade. This is what criteria really means. You got to know what options to sell. You got to know what options to buy. But you also have to know where there's some edge, okay? And when I say edge, what does that effectively mean? When I say edge, like, how does this trade work? You know, let's say, for example, that this particular trade had, okay, let's call it an 80% probability in this trade. Right? Let's say this trade has an 80%. Where's the probability? Like, how do I have an edge in here? First of all, can the stock move? Yes. This stock can come down here to 90. This stock can go up to 110. But the last time that I looked, when the stock moves, the stock takes what? Time to move. And as the stock takes time to move, the options that you sold start to do what? Decay. Now, that's something that's quite advanced for tonight's session. But a seller of this spread takes an edge, okay, if they know which options to use and which options are going to be the right amount of decay and what's the right probability embedded in the trade. Because if you have the right probability, if you have the right criteria, okay, you're going to know exactly where to sell this spread and that time and how long it will take for the stock to get to that level gives you a definitive edge in the trade. Let's take you through another one here because this stuff, again, you got to go through example after example after example. And it's important that we go through example after example. Now, bear with me here. I have to, I got to fix something on my PowerPoint here momentarily. So let's make sure we're all good to go. All right. Hang on there 1 second, as we have a PowerPoint issue. All right, here we go. So with that, we're going to jump right to the next slide. We are good. Perfect. Now we're going to get right to our call spread. So sorry for the 2-second interruption here. I must have clicked a button. I've had a lot of caffeine. Short call spread. With a short call spread, let's say we have a stock trading at 200, right? This could be any number of stocks out there. Stocks trading at 200, you're going to sell a 220, 225 call spread. Now, this is exactly like we did a moment ago. We used a $100 stock. Here, we're going to sell a 220, 225 call spread. We're going to collect $1. How much risk is in this trade? Come on, let me tell you. I want to know how much risk is in this trade. Well, first of all, okay, this trade is about a 20%, okay, loss to 80% win. I'm going to show you how to do that. We're actually going to be able to calculate here momentarily probability of success. We know something on this spread, okay? This spread has $1 credit. Now I'm going to take you through this fast, and then we're going to hammer it, example after example. This is a $5 wide spread. In a $5 wide spread, we collected what? $1 credit. Therefore, and this is the most important thing, the definitive out-of-pocket risk. The definitive out-of-pocket risk can't be more than $5. You cannot have more than $5 of risk on a $5 wide spread because that's the distance between the two of them. Again, it's the distance between the two strikes, right? That's called a $5 wide spread. On that $5 wide spread, we collected $1 up front. That means our definitive out-of-pocket risk is $4. You cannot lose on this trade more than $4. Okay, now here's the calculation. Take $4 divided by 5 equals 80%. It's an old school calculation. This is the way that most traders learn to do this on the trading floors is they go out there and they say, it's the definitive out-of-pocket risk divided by the width of the spread. I'm going to show it to you again. Okay? Let's go to a probability of success. Calculating your spread's probability of success. Take the real risk in the spread divided by the total width of the spread. Probability calculation details are as followed. Okay? Time out. Now we're going to look at an actual trade. Yeah, this is real because I took the screenshot today. I don't like using antiquated examples. I trade, by the way. I trade a lot. And if you can't tell that, well, you haven't traded before, but lots of people do lots of examples. And, if you've been to sessions before, I can always tell anyway when people trade. I trade and I put on spreads like this continuously. I'll show you in a minute. So this is just a vertical spread that I brought up. It's on Netflix. Now, I just brought this one up for argument's sake. Let's say in this example that we were bearish. By the way, being bearish in Netflix can be hazardous to your health. It went down today, but so be it. Anyway, this is how wide's the spread. Come on, it's the width of the spread. It's right here. Okay, you gotta take what you're learning and you gotta be able to translate what you're learning into context of the live market, right? So here, I'm actually, in this case, selling. You can see it sell one of the 360 calls. Then I'm buying, okay, one of the 365 calls. So this is what? It's a 360, 365. That makes it $5 wide spread. Of which, and this is real, this was real pricing today. This was for $1 credit. The reason I selected this one today is because it was at $1 credit. So it was $1 credit. So what's the calculation? That's the total you can lose. The real risk in the trade is $4. Look, you received $1 credit. It's a $5 wide spread. Definitive out-of-pocket risk is $4. So to figure out the probability, take the real risk, which is $4, divided by the width of the spread, which is $5, comes out to 80%. We having fun yet? Pretty easy. Okay, it's a 360, 365 spread. 4 divided by 5 equals 80%. I like it. Let's do another one. Come on, let's do another one. And by the way, I told you that tonight you'll know your probability without having to use any crazy calculations. Oh, I'm sorry, you have to divide one number by another number. If you have this thing, call the phone. They actually have calculators on them. All you got to know is the width of the spread and the credit received. That's it. Width of the spread, credit received. You can calculate this. No binomial models. There's no Black-Scholes model. Now, here's a recent Tesla example. I just wanted to throw this out because, well, this is a trade. If you look, that's the date that I placed it. on February 21st. And the only reason I selected this example, because the example was, look, it was a how what? It's a Tesla example. It was done for the March 29th. And what's the width of the spread? Oh, it's a $5 wide spread. What did I receive? That's a real credit. This is a real trade. Okay, that's the exact execution time of the trade. 8:14. By the way, that's 8:14 Mountain Standard Time, because if you were on Central Time, the market would not be open at 8:14. It's on Mountain Time. I received a $1 credit for the $5 wide spread. So my definitive out-of-pocket risk was about $4. $4 on a $5 wide spread. This trade really did have about an 80% probability. By the way, this is the closing trade. As I said, I wanted to show you something that's recent. Is that recent enough for you? Okay. If you're not seeing it, I closed it today at 7:54. It actually closed itself for a 40-cent debit. So it's a trade. It was closed. Let's do another one. Let's do another example. Let's do Amazon. Dun, 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 the beast. The reason I like to show an Amazon example, and I'll tell you what, I love doing the Amazon example. Amazon trading in and around all-time highs. Every day I could say that. Amazon's at all-time highs. Amazon is at all-time highs. Let's sell an out-of-the-money spread. Now, if Amazon today, and by the way, when I took this screenshot, Amazon was trading 15.34. I know it. It closed somewhere at like 15.45, I think. So it closed a little higher than that, but this is when I took the screenshot. So, hey, listen, it's a live market. Things don't always work out perfectly. Anyway, on Amazon here, we're going to sell, okay, an out-of-the-money spread. You know, we're going to sell a couple of monkeys here. We're going to buy a few monkeys out there. What are we going to have? Defined risk. That's what we're going to have. Let's go to it. Let's actually show you a real spread. Okay, now this is a trade that you could do. This is exactly when I took the screenshot earlier today. The stock was trading at 15.34. We're going to sell the 15.80 calls. We're going to buy the 15.85 calls. This trade, well, what's the width of the spread? You tell me. What's the width of the spread? It's a $5 wide spread. How much should I collect? $1.50. What's the probability? How do you figure it out? Now, I'm going to show you on the next slide, but I want you to realize how to do this. It's a $5 wide spread. Okay, what's the most I can lose in a $5 wide spread? Well, you could lose $5, but you collected $1.50 up front. So it's $3.50 divided by 5 equals, what is that? It's about 70%, which invariably gives you a 30% chance of getting your head taken off. Think I don't know that? Because that's exactly what everybody's going to ask. Okay? And this is fun because this is where people think that, you know, the options that I selected, check this out. People think that, you know, you could just go out. You know, I did a 16-day. On the Tesla trade, I did one that was about a month out. Okay? I'm going to tell you something. The options you select in here absolutely, okay, absolutely have to be on the ball. You better know exactly what options to sell, exactly what options to buy, what expiration to select. That's what the trading is about. This is not done in some like obscure manner. This shouldn't be ambiguous. Okay? You got to know exactly what options to trade. Now, probability solved. Amazon is at 15.34. We're selling the 15.80 calls and we're buying the 15.85 calls. The net credit is $1.50. The max risk is $3.50. The width of the spread is $5. Take $3.50 divided by $5 equals 70%. There you go. You got to trade on Amazon. You want to see the reality of it? 70% probability in the 30% hammer. Because that's everybody's question. 70% sounds great. I'll take it. But 30% of the time, the market's going to rip your face right off. That's, by the way, if you've never heard this term before, it's the first time you're going to hear that. Market rips your face off. That's been a trading term, okay, since literally a century ago. When you trade high probability strategies and you're wrong, you get hammered. All right. How many people have actually ever done this before? Check this out. The market's just evil enough to allow you to make money 3, maybe 4 times. I want you to think back. Anybody that's ever done this trade and you've sold options, the market, it knows you. It knows what scares you. In the market, again, it's just evil enough. It lets you make money 3 or 4 times. You increase a little bit of contract size, and then train wreck. Your losses are going to exceed the gains on the previous 3 trades. Yeah, You think I haven't seen this movie before? I know. It's like I can see your account. For the previous 15 years, I could see your account. Okay? I mean, come on. Nobody's ever done this. I mean, that's what you have to think about. By the way, all this stuff, like people are like, well, what if I'm assigned? We cover all that. And then here's the fun part. When people are losing money in these spreads, they go, I can fix it. I know I can fix it. Fix in this business, dirty, dirty word. I don't ever want to hear that. 15 years in the brokerage business, I'm totally cynical regarding good trades gone bad. Right? I mean, literally, you watch people trading for 15 years. Do you know how painful sometimes that is? You can see people doing things from the other side of the screen, and you're like, no, don't go in there. It's like watching, I said it a moment ago. It's like watching, it's like watching a movie. It just is. You know exactly how the movie is going to end. It's a really bad horror movie. It actually sucks so bad, but you can't stop watching it. And I'm serious about this. I'd sit there and I'd watch in really volatile days, and I'd watch people like, oh no, don't do that. No, and of course they get their head taken off, like, don't go in there. That person has a chainsaw. Anytime you're fixing a trade, you're adding more risk to an already losing trade and racking up transaction costs. You think about that? Sure, some fixes will work, but the very notion of a fix is throwing good capital after bad. It's like the first thing that you learn about this business. Don't throw good money down a losing hole. It's the first thing that people learn in the business. But, I'm sorry, it's not good capital after bad. We're calling it a fix. It's a different term. It's absolutely ridiculous. Yesterday's trash. Take a car and drive it off a cliff and then bring it to a body shop. The body shop will tell you the same thing about the car that I'm going to tell you about your losing trade. It's a piece of crap. It's a piece of junk. Let it go. You take a car, drive it off a cliff, and bring it to a body shop, they're going to start laughing at you. You need to learn how to do this right. Learn how to correct good trades gone bad. You have to select the right options to do these trades on. Okay? That's the key. You want to learn how to sell spreads and how to control your risks the right way. Let's discuss a little bit about criteria. And that's what we harp on here. This is what we do at TheoTrade. Okay? We do criteria. And you're like, well, what's criteria? It's about answering all of the what ifs. I don't know. What might be a good stock or ETF candidate for me to sell a spread on? Right? What's the correct options expiration cycle to sell my spread? How much capital do I commit to generating short spread premium? What strike prices do I sell? What strike prices do I buy? Think about that. A lot of questions, right? That's what we answer. This is the kind of stuff, listen, I did this, okay? I taught clientele, 7 million clients, and this is the kind of stuff that they wouldn't allow us to do on the brokerage side. Because when you work for a brokerage firm, you got, the SEC and FINRA breathing down. You can't tell people what's the right probability for my trade. Well, guess what? We can now at TheoTrade. We can tell you what's the right probability. How many option contracts do I trade for my account size? When do I close the spread? What if the stock sells off big? Do I bail out of the short spread? What if the stock rallies massively? Can I fix a losing trade? I just hammered that. Okay, we have the answers. We have all the answers to all the trade related questions. Somebody just asked, like, one of the great what's the open interest in here? Somebody said that. Another person came in here. What about assignment? Of course we'll cover assignment. We build recipes. If you want to learn a strategy, I'm serious. If you want to learn a strategy, go Google it. In fact, you don't have to Google it because I just taught it to you. That isn't going to tell you, though, what criteria to use. We just build a checklist. Each strategy has unique, every variable, okay, you're going to encounter along the way. Think about it. Earnings are approaching. What steps do I take? Right? How, when, why, at what price? Can I sell options without ever owning the stock? Of course you can. This is just the beginning of some of the variables you're going to face. Okay? The secret, it's always going to be in the sauce. Again, as I said, you may be thinking, I could read about selling spreads anywhere. You can Google it. Seriously. The following strategy and the corresponding criteria requires the utmost attention to detail. Okay? We spent years fine-tuning some of the criteria. The key, all right, to the spreads is actually following a checklist. It's just like going out there and baking a cake. You're going to bake a cake? You got yourself a recipe. You're going to fly a plane? You got yourself a checklist. I don't care what you want to call it. But in almost every genre, okay, of whatever you do in your life, there are steps that you take. Is something as easy as going out and like driving a car? What do? I get in the car. Sometimes I put my seatbelt on. No, you actually have a checklist of pretty much everything you do. Becomes second nature. Although some people jump in the car, spill coffee on themselves, drive the car, smash into something. There's always going to be those drivers. But I'm just making a point. I mean, I want you to think about everything you do in everything in your life. I mean, you take a shower, you have a means to taking a shower. Okay? I will wash here, I will wash there, I will wash everywhere. But everybody, okay, is absolutely methodical. How do you think that traders function? That's what they do. You spend years fine-tuning trades and setup. And you know what? You spend years losing money. I came from a family of traders. They gave me a lot of the criteria, okay, way back when. Now, it's just been refining criteria for 20 years. But the way that I was able to refine criteria was also studying, okay, millions of other traders. And that's one aspect. I don't care who you are in this industry. Nobody else has spent that amount of time studying clients. There's nobody else in the entire industry that spent the time to actually study clients. Nowhere. Okay? Can you name one other person that worked at a major brokerage firm for 15 years and had access to over 7 million accounts? Okay? That's what this stuff is about. You want to build a short spread? We have a guide to selling high probability spreads. Okay? It's a 4-hour course. It's available right now. It's on demand. It has unlimited access. The class slide deck that includes entry and exit criteria. You can, right now, you can get it for download. Okay. In addition to the class, we have, okay, a multitude of bonuses with this class. Now, give me a minute because I want to go through each one of the bonuses because a lot of people are like, I don't even understand the basics of options. Totally get it. Bonus number 1. It's Options 101. Now, a lot of you may have tuned into this already. It's the basics and beyond. Okay? This is kind of like a prerequisite. Then we give you Options number 2. Okay? 201. Verticals and Calendar Essentials. These are to get you ramped up. Then we get you into a little bit more of the extremes. Options 301. It's called the Volatility Essentials. This is where you start learning about things called expected move. That's where you start learning about, standard deviation in trading. Okay, the Volatility Essentials, that's everything you're going to need to know in probability and more. Okay, then we actually have a TheoTrade probability calculator spreadsheet. You're like, well, what's that? I'll show you what that is momentarily. You know that little risk reward where we went out there and did the $4 divided by 5? We have a spreadsheet that'll do it for you. In addition to all 4 bonuses, we'll also give you a 1-month access pass to TheoTrade itself. I will explain what that means. The 1-month pass, okay, is incredible. It gives you access to all of our coaching archives, all of our chat room archives. Somebody was asking a question, right? Somebody was asking a question about assignment. Somebody's asking a question about dividends. If you have a question, and by the way, I'm just talking about options right now, but if it was futures, stock, options, technical analysis related, okay, I will put anything that we have that available to you, and you're going to have a 1-month access pass to it. You got a month to watch as many videos as you can. Listen, our class, it's $199, okay? But it includes the entire sell high probability. And by the way, it'll give you unlimited access. So even after the month is over, you can still access the high probability class. You can still access, 101, 201, 301. The 1-month access pass, what that does is it gives you the full gamut. You can search anything you want, okay, in there. And I'm telling you right now, you challenge me, go for it, okay? You want to know about MACDs, you don't know about Fibonacci's, we got people for that. The entire thing is $199. We do that. We want you to experience what TheoTrade is. Go to TheoTrade.com/trade. TheoTrade.com/trade. Okay. I will show you this page here momentarily, and we're going to come back to this because I want to answer some of the questions. Just click Add to Cart in here. All right. But before I get to there, before I actually show you the page, right, I want to take you through a little bit of, again, what is a 1-month access pass? What is the curriculum for the course? This is the guide to selling high probabilities curriculum. You're going to learn how to sell the correct spreads, maximize the benefits of time decay. You're going to learn entry and exit criteria. It's all about consistency. You have to learn to identify favorable short spreads candidates, okay, versus non-favorable. How to identify risk reward like never before, okay? And you can actually perform really in any market condition. You're going to find that out as well. You will find, though, that this works better in higher volatility. A lot of people use this strategy on the professional side to generate consistent returns. You know, why so many really experienced traders learn to reap the benefits of option decay. Which stocks and indices make the best candidates? The strikes, the expiration period, all of it to give you the right probability of success. When to open the trade, when to close the trade, the exact probability of touching and how it's calculated. Okay, all of those are going to be factors in determining a good spread. Now, this is the probability calculator. It's just a spreadsheet. This comes with the class. You don't necessarily have to use it. It is not complicated. It is taught in the course itself. Now, again, that course, you can start streaming it right now. As I said, you know, people, listen, people all the time, they'll spend, how many hours a week do you spend on Netflix? And I mentioned Netflix because, you know, we pay what? You know, 10, 15 bucks a month for Netflix. I've got it in 4K. Just take a month off Netflix. I'm serious. Take a month off Netflix because the 1-month access pass, okay, it's everything we do online for the next month. Everything we do. And if we do a class and listen, you have access for the next month. We are going to have multiple classes in the next month. Do you realize that the classes will cost you $199? But if you have access for the next month, you don't have to pay for the class because it's included in the 1-month access pass. We don't hide anything from you in the next month. This is what you get over the next month. You're like, oh, this is a bad month. I get it. Like, oh, here. Daily coaching sessions. Timely topics, stocks, options, and futures. Each day, we broadcast live in a chat room. Each day, we broadcast live in the chat room for approximately 5 to 6 hours per day. You're like, that's a lot. Yeah, you don't have to be there the whole time, but you can tune into the archives. If you can catch it live, right? By the way, there's stuff going on right now. And you're like, what do you mean right now? Oh yeah, we actually do a Wednesday night happy hour. Corey's doing the Wednesday night happy hour. Okay, see, this is it. He just finished moments ago. He just finished the happy hour in here. Archive is already posted. It's pretty cool. This is everybody that's in the chat room right here, right now. Like, it's live, it's uncut. This is what TheoTrade looks like. Now, cutting back to that, we give you the live chat room. There's real trade ideas being shared in there all day. We give you all the archives and access to the archives. There's also a Start Here selection. Okay, you know what Start Here is? Let me bring it up. You click Start Here. When you go to Start Here, I mean, listen, you're going out and you're buying one class. You're buying a class to learn how to do credit spreads. But you also get access to everything in here. You know, there's a 3-part series that I put in Start Here. Okay, this is just Start Here because you're like, I don't know, I'm new. I don't even know where to start. Order execution, part 1, part 2, and part 3. Order execution alone, you know, this course costs $199. Okay, I'll tell you something. That alone is going to save you a hell of a lot more than $199. That's the thing that people don't realize. Okay, I'm going to tell you, you are not going to be disappointed in what we have in here. I mean, are you going to be overwhelmed? Yeah. But in the next 4 weeks, listen, you're going to go through a lot. I just always ask this question. I don't know. Would you rather be overwhelmed or underwhelmed? You know, you go to like a restaurant and you're like, wow, that was a really underwhelming meal. My wife takes me to a place all the time, not picking on salads, but it's a place they just do nothing but greens. And every time we go there and I leave that restaurant, I go, hey, on the way home, can we stop at In-N-Out Burger? Every single time. And it always makes me think of this. You will not need to stop at In-N-Out Burger after, you know, TheoTrade. Never. You're never going to go anywhere ever again because you're going to find out really, really fast. You want to see what else we have in here? You can go under Member Home. You want to see what Member Home does? You can search any topic imaginable. Okay? You want to know about something like, I don't know, what do you got? You know, let's look under volatility bombs, and hit search. You're like, I don't even know what a volatility bomb is. There you go. There's a coaching session for it. There's sell premium manage risk coaching session. It just goes on and on and on and on. If you want to see what an archive looks like, all right, if you want to see what the TheoTrade archives tend to look like, let me go back to the member home over here. The archives, here they are. This is a member coaching archive. I just want to show you, listen, you want to go back into like October of 2017, okay, understanding intraday market relationships, build me a trade, skills for building viable trade ideas. Every one of these, SPX, VIX, and volatility-based products. I know it's overwhelming, okay? It's good. By the way, the Start Here selection, all the archives, we'll also email you trade ideas. And there's one more great thing. We don't sell indicators. I hate when people sell indicators like, I have the best indicator. It's $500. Oh, please. Okay? Nobody has a good indicator. It's all garbage. Just give here. It doesn't cost us anything to build indicators. Okay? We pay one time for somebody to build an indicator for us. Here's every indicator you're ever going to need. Seriously. Okay? These are all proprietary indicators. We had coders build the indicators. Whatever. It costs a couple $1,000 to have somebody build an indicator. We give them to you. Okay? And that's important to us. Now, let me answer a couple of questions. Now, again, all of this stuff is found, and I want to bring up the site really quick. You got to go to theotrade.com/trade. The whole thing is $199. Again, you're not gonna go wrong, and you're not gonna have to go to In-N-Out Burger after that. Okay? So when you start to look at this, I like it. Somebody goes, I think you just offended 15% of the population who are vegan. I hope that I did. By the way, I live in a very strict home in terms of what we can eat. So you better believe I have to stop at In-N-Out Burger. But, that's In-N-Out Burger. Got to do it. High probability credit spreads. Okay, this is a little bit of a fact sheet. Is this a trial subscription? Will there be additional billing at some point? Okay, no, this isn't a trial. Okay, you'll have unlimited access to the on-demand recording of the class and the bonuses. This is a one-time $199 fee. That question invariable comes up. Okay, so and by the way, somebody's asking another one. I'll come to that in just a moment. So and again, trial subscription, absolutely not. It's a $199 fee. Now, I don't have experience with options. Will I be able to follow along in the class? Of course, by offering the bonus sessions, the 101, the 201, the 301, right? We're prepping you for the high probability credit spread course. And we're giving you access for a month. By the way, in that month, I want you guys to know that you can ask questions. Okay? You can ask questions the whole month. We don't care. Come in the chat room, ask questions. You're like, I work during the day. Don't worry. We have Wednesday night sessions. We do Q&A sessions. You can email us. Yes, we respond to emails. Another question. I can't get approved for options because I'm a newbie. Will your class help me get approved? Yeah, of course. TheoTrade course offerings are accepted at several major brokerage firms as experience. We can walk you through, okay, the options approval process, period. Okay. I also want you guys to know, if by chance you have a TD Ameritrade account, if you enroll for this class tonight, we will give you the TD Ameritrade discount. Okay. That discount cannot and will not be mentioned on any live broadcast. They give us a spectacular rate for anybody that goes through the TheoTrade courses. Okay, that particular discount is specific to TD Ameritrade. Right? If you don't have an account at TD Ameritrade, we have relationships with a lot of different brokers, but the best discount that we have is unequivocally at TD Ameritrade right now. Okay, and that's something that, again, somebody's like, oh, I was at Scottrade. If they took over your Scottrade account, you qualify, sir. You qualify. That's why they don't have 7 million clients anymore. They have just shy now of 12 million clients. You know why we have a good deal with TD Ameritrade? Number one, I worked there for a very long time. Number two, it's because they're the largest by far. They're just a monster. 1 in 2 people joining this webinar tonight would have a TD Ameritrade account. If you don't, we actually have a great link for that. So we can actually give you a link to open up a TD Ameritrade account that would give you that will actually give you a discount. Anyway, we'll post that TD Ameritrade link in there. So that question is an easy one. Next one over here. Can I trade these strategies in my IRA? Yes, you can. In fact, I trade almost exclusively now in my IRA. So I don't mind telling you guys, back in 2007, I helped take a company public. It was at that point where, I didn't necessarily need income anymore. I don't mind telling people that. I started trading in the late 90s, helped take a company public in 2007. Then we were eventually acquired in 2009. So we did well. At this point, I'm 42 years old in about 2 weeks, and I trade exclusively inside of my IRA now. Starting in 2018, my accountant said, you don't need the money. Trade in the IRA so you do not have to pay the IRS. And I said, that sounds like a good idea. Anyway, I work full time and I can't trade during the day. Can I use this program? Yeah, of course. I mean, there's actually an entire area in here. These trades can be set up and walked away from. You need not monitor spreads during the trading session, as the risk in the spread is defined. You just got to set it up following our criteria. Furthermore, you can create good till canceled orders, GTC orders, and exit the trade, okay, and exit that credit spread at your projected profit point. Again, this is all covered inside of the class. Next, I have a larger account. Will your system help me? Sure, any size account. You can have an account $2,000. You can have an account $2 million. There's even a little portion about allocation in here, right? So the concepts, size is limitation of mindset. Next, I swing trade stocks. How's this class going to help me? Imagine swing trading without having to take enormous risk of owning the stock, okay? Right? Or worse, being short the stock. Spreads, okay, will define your risk, keep you out of harm's way, and allow you to use swing trade techniques with minimal risk. Now, that's the website. Let me actually show you the page itself, okay? Now, again, the page is actually found under TheoTrade.com, okay? TheoTrade.com/trade. Let me maximize this on the screen so you guys can see it for a moment. Now, here's where you go. You sign up for $199, okay? Everything that's included in here is listed, and I've gone through it all. The 1 month access pass, archives, okay? You'll be able to access the guide to selling high probability spreads class immediately. It's lifetime access. It's an on-demand recording in addition to the 1 month pass. Now, for the individual, and I throw this up here, and I'll give you this, and then I'll answer a couple of more questions, right? There are individuals that simply need everything, and you want to know what everything, because everybody asks me when they go to a class like this, they always turn around, they ask me like, all right, let's get it out of the way, man. What else can I possibly buy? Well, I'll tell you what, we do have something for $2,000. If you want to do it, because for $2,000, you will get more than you have ever dreamed. Let me show you for a second. We do, okay, approximately once per year, a live class. The live class is held here in Scottsdale, Arizona. It's about a 2.5 day class. It's from May 3rd to May 5th. So many people are asking about it that I'm mentioning it tonight. The $2,000 is not for just a live class. The $2,000 will actually give you a full 12-month access to everything that we do at TheoTrade, and it will give you retroactive access to everything we've ever done at TheoTrade, and it gives you the live class. Okay? So not everybody can necessarily make it to the live class, but it's an offer that we wanted to present to you. Okay? It's every class you could ever imagine. It's all the classes that are listed below here. High probability trading, covered calls, iron condor, selling premium, survive and thrive in volatility, a fractal energy class, technical analysis 101, 201, plan or get slaughtered class. There's a fundamentals class. There's a day trading class. There's the whale workshop. Do you know each one of these classes, we were charging, $100 here, $100 here, $100 here. Add it all up. Okay. There is no other education anywhere in this industry that will be anywhere near what you can do at TheoTrade. Okay. And that's why we put this on the site. For $2,000, you get to go to a live class. Oh yeah. And you get access for an entire year to everything that we've ever done and everything that we're going to do in the next year. And that's why we threw it on there. Again, the site address is theotrade.com/trade. Okay. I invite each and every one of you at the absolute minimum, you got to go through the guide to selling high probability credit spreads. It's a must. For those of you, and again, there's always somebody, I must have everything. You want to know what everything is? Come out to the live event. Again, the live event, it's something we don't hold anything back on a day-to-day basis, but the live event, it's a really special 2.5 day period. We max this thing out, the 2.5 day event. It is maxed out at no more than 200 people. We bring in all of our instructors. You get ample time. By the way, just some of the topics of the live event. Okay, one of them is called Return to the Trader, intraday volatility shifts, fractal analysis. Okay, each one of these is a course, and that's ultimately done over a 2.5 day period. So again, we invite you to come out to that. I'm going to look for a couple of questions. By the way, if you don't like flying, drive. Okay. Deborah, the answer is yes. Deborah's asking about commissions. So if you pay the $199, you do get a discounted rate. You do get a discounted rate over there. By the way, Don said, if you sign up tonight, do we have to start using the 1 month today? No, you can email us. I get it. Like somebody's like, let's start it in a week. You can do that. All right. You can totally do that. That's fine with me. All right. So again, I'm just reading back. By the way, $199 of access is just something that we do. Okay. Because we want you to have support. Like, I don't like when people go to a class and they just feel like, all right, I've gone to a class, get out. That doesn't make sense. Okay. I don't want you to get out. I want you to go to the class, and I want you to spend some time with us. And I want you to understand not only everything in the class, you got to understand a bit about the market, a bit about order execution. It's the right thing to do. Right. And that's why we put that class together. So I'm a bit over my time. I want to thank everybody for joining us tonight. It's been good. It's been wonderful. Thank you guys very much. Have a wonderful evening. Bye-bye.